Welcome to the Market Mosaic, where every week we are breaking down the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to formulate a view of where stocks could be headed over the near term. And look, we got a really big week ahead of us. We had a lot of very key developments happening last week, so let's just jump right into it. So we had a plunge in several stocks leveraged to the AI trade. Along with cryptocurrencies, Bitcoin hitting levels last seen before the 2024 election, but lost in the headlines. Those developments could not stop the Dow Jones Industrial Average from jumping to a new record high over the 50,000 level. First time ever getting there. So to many investors, it probably appeared like a significant risk off move was underway across the markets because you had high profile AI stocks like Palantir and Microsoft seeing steep losses. Just those two names alone. Palantir is 34% off its prior high set last year. Microsoft is about 28% off its prior high. So these are some very major drawdowns underway. And at the same time, Bitcoin dropped to its lowest level since October 2024. That's wiped out the entire rally following Trump's election win. And it comes despite his administration's crypto-friendly policies. But while these movements on the surface distracted from bullish developments under the hood. And so you see mega cap growth stocks struggling, but the average stock is really holding in here, so well. It's off to the average stock is off to the best start in several years. So the chart on here shows year to date through February 5th, the number of stocks that are outperforming the S&P 500. So take this with a little bit of grain of salt because we're still early in the year. But at this point, last several years where we've seen the AI trade and the Magnificent Seven absolutely dominating the markets, you've seen the average stock struggling to keep up. So, the Mag 7's accounted for a huge share against the S&P, especially years like 2023 when only 34% of stocks were outperforming the S&P. 32% in 2024, 31% in 2025. So these are preliminary numbers. Now look at what's happening so far this year. Again, it's year to date, but 66% of the stocks in the S&P 500 are outperforming. So again, you're seeing this huge jump in terms of the average stock outperforming the cap-weighted index. So that's a positive development for breadth. Now the other thing that's happening is that cyclical sectors are starting to lead the way. So last week we saw ETFs tracking banks breaking out. We saw industrials breaking out, small and mid-cap stocks that are more sensitive to developments of the economy, moving to new highs. Well, another one is with the transportation sector. So transport stocks, these are sensitive to economic activity for a pretty obvious reason, given that these are companies involved in moving freight. And one thing you'll notice with the transportation ETF, IYT on here, is you had this lengthy base period going back to late 2024, and we broke out at the very beginning of the year, at the very beginning of December, came back to backtest this breakout level of 75 a couple times, holding over this 50-day moving average, and now we're just off to the races again. So this IYT transportation ETF moving out to fresh record highs. So we're seeing the right sectors are participating in the upside. It just points to this massive rotation that's been underway since the start of the year. It's a trend that picked up last week because by some measures, momentum stocks are seeing historic underperformance relative to value shares. And I think a big driver of this is the outlook for economic growth and what it means for interest rates. So it's leaving overvalued areas of the markets exposed because valuations in the top 10 stocks in the S&P 500, the 10 largest by market cap, their valuations are running significantly above their historical average. So this week I want to look at some of the catalysts behind the sell-off that we're seeing in growth in AI stocks, but why that's boosting other market sectors. And then we'll also take a look at the state of market valuations and why the broader market indexes are vulnerable to some developments that could impact interest rates and inflation. All right, look, it's no secret that stocks leverage to the massive CapEx investments, in the spreading adoption in AI. Those have been some of the top performing stocks since the cyclical bull market started in late 2022. That's a trend that continued into late 2025. In many of the market's top performing stocks, they belong in sectors that I would characterize as speculative growth. A lot of them are stocks with high valuations, like high PE ratios. Now, what ends up happening is that a lot of these stocks rank well on the momentum factor. So momentum is a factor used by quantitative investors, and it favors the best performing stocks over an intermediate term look back period. So looking back, the momentum factor, you want to hold the top performing stocks over the past 6 months and past 12 months. But many of the stocks that rank well in the momentum factor, they peaked in late 2025. And all of a sudden, we're having this big unwind pick up late last week. So what the chart on here is showing is the daily return spread between a basket of momentum stocks and a basket of value stocks. And you can see that value, at one point last week, again, it's a daily return, value stocks outperformed momentum by the largest degree since late 2020. So again, we're just seeing this massive magnitude of underperformance in momentum stocks. It's something that has started in the last several months, and we saw just an absolutely incredible spread between value and momentum returns last week. All right, so given there's been a lot of investor excitement and exposure to the types of stocks that rank well on that momentum factor, stocks that have performed well over the intermediate term. And so last week, given the investor exposure to these areas of the market, last week's sell-off in AI companies and growth stocks in general probably had a really big risk-off feel to it. Many members of the Mag 7 are pulling back, given their weight in indexes like the S&P 500 and the NASDAQ. You're seeing the NASDAQ or the indexes decline, but the moves are masking a surge in the average stock. The average stock is having its best start to the year relative to the cap-weighted indexes in over 3 decades. So what the chart on here is shows the year-to-date spread between the cap-weighted S&P 500 versus the equal-weighted version of the index. So when this is positive, it shows essentially the average stock in the S&P 500 is outperforming the cap-weighted version, and you can see that the equal weight version of the index is outperforming the cap-weighted by 4.2% through last week. That is, look back, this is the best start for the average stock in the S&P 500 since 1992. So just an ongoing rotation to the average stock that has been underway. That's a very strong signal, a bullish signal for Brett. A major catalyst driving this diverging performance in growth stocks and AI stocks relative to cyclicals is really coming down to the outlook for economic growth and what that means for interest rates and inflation. So for instance, last week saw the release of the ISM's manufacturing PMI for the month of January. Remember, these things are constructed so that a reading above 50 indicates expansion, below 50 is contraction. Well, it jumped above the 50 level and hit its highest level in 4 years. What's even more important is that the leading new orders component, it's a leading indicator of activity, it surged to its best level since early 2022. And it's not just the ISM. We've seen many measures of economic activity are surprising economists to the upside, but where this comes back to bite growth stocks is that it could start to pull long-term rates higher. And I'll explain why in just a minute. But this chart overlays an index of economic growth surprises, that is the darker blue line on here, overlays that with the 10-year treasury yield, the lighter blue line. Now this goes back a couple years to start 2024. And you can see, just visually that this tends to, these two series tend to be very positively correlated. And that's not a surprise because rising growth expectations should have an impact on inflation, and a better growth outlook tends to push yields higher as well. So you get this dual impact to rising growth surprises and how that impacts yields. And we're seeing, again, just look at this surge that we've had in growth surprises. You've not really yet seen a corresponding move in the 10-year, but that could be something that is heading our way in the weeks and months ahead, is that if you start to see this 10-year treasury yield, see pressure on interest rates on the longer end of the curve, get pressured higher because of this big surprise we're seeing in economic data. So the combination of stronger economic growth, at the same time you have the high core inflation, I think that's really starting to cast doubt on the interest rate outlook across the yield curve. It's both in terms of short and long-term rates. So accelerating economic growth, that can push longer dated yields higher, but it can also challenge what the Fed can do on the short end as well. Now, I think those variables are a major catalyst behind the sell-off and growth in AI stocks this year, given their collectively speaking, very elevated valuation. So the top 10 stocks in the S&P 500 trade at a forward price to earnings ratio of 27.1 times. So the green line on here, this tracks the forward, so using expected earnings, the forward price to earnings ratio of the 10 largest stocks in the S&P 500 currently sits at 27.1 times versus the historical average at 20.7 times. So rising interest rates hits in a couple different ways, especially when you have elevated valuations like this. Rising rates makes the present value of future profits worth less in today's terms. That's especially impactful for growth stocks that make up this top 10 because a lot of their earnings potential rests far off in the future, so that makes them more susceptible to that present value impact and with rates. Not only that, but higher rates presents competition for investor capital. If you can go park your cash in something that's relatively safe and stable like a treasury, as rates rise, that trade-off becomes more attractive. So with evidence pointing to strong economic activity, investors need to monitor the impact on inflation. Many measures of core consumer inflation, have been stuck near 3% year-over-year growth since about mid-2024. So we've been here for a while. The disinflation trend off inflation's peak in 2022 has stalled out for almost a couple of years now. And there's been some warnings from leading indicators of inflation that we could see inflation inflect higher again in the months ahead. One of those was the producer price index a couple of weeks ago. That came out for the month of December. Now that core figure strips out food and energy prices. It rose by 3.3%, which was a lot higher than expectations for 2.9%. PPI tends to lead the CPI, so that's worth noting. Now another index, what we're showing on here, this comes from Adobe. This tracks online price inflation. So this is called this is a measure they put together called the Digital Price Index, and it showed an unusually strong spike in online prices in January. That's what this black dot on here is. This is for January 2026, and you can see this is the monthly percent change. This ranks as the biggest jump in this index in over a decade. So you can see where this falls in January of prior periods, including 2025, 2024, 23, and the years before that as well. So we'll see if this is a one-off, but that is a large abnormal jump in this online inflation tracker from Adobe. All right, a lot of key economic data coming out this week, especially as it pertains to influencing the Fed's monetary policy. So the non-farm payrolls report was delayed because of a brief partial government shutdown. That is supposed to come out this week, so we'll get a look at the labor market right now. The forecast is that payrolls will come in at 70,000, accelerate slightly from the prior month, and that the unemployment rate will hold steady. So that covers the Fed's employment mandate, but then we're supposed to get a look at CPI as well, so consumer inflation. This will be really important coming off the heels of that hotter than expected PPI release the other week. So for January, year-over-year CPI is expected to moderate to 2.5% from 2.7%. So keep a close eye on that CPI report and how many of the components within that are still being estimated. All right, one trade I want to keep an eye on this week. We're seeing some great relative strength out of Veritiv Holdings, ticker VRT. So this stock originally peaked out right at the 200 level, which is a nice round level. That can be psychologically important in numbers like 100, 200, and so on. Peaked out there back in late October, early November. Started this new basing structure. Now, what's caught my eye within this basing pattern is that we've come right back up to that prior resistance level, and we've made a smaller pullback so far, a smaller pullback that's getting this bullish MACD reset above the zero line. So we had this nice big bar higher on the rally across the market that we saw on Friday last week. So all the conditions are there to help support a breakout. So the smaller pullback suggests accumulation in this basing structure. There's good momentum behind the name. The relative strength line, this is the relative price performance of VRT relative to the S&P 500, is holding near where it peaked out the prior time. So we're going to look for a breakout over 200 on rising volume with ticker VRT. All right, that is